Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Liquidity Risk in Investing, what you need to know. Ever wondered why some investments seem safer than others? It's all about liquidity risk. Liquidity risk is the chance that an investment can't be quickly sold without losing value. For investors, understanding this risk is crucial. Knowing how easily you can buy or sell an investment affects your decision-making and financial stability. We'll explore what liquidity risk means, how it impacts investing, and why you should care. This video will give you practical insights to help keep your investments secure and profitable. Let's get started and understand the ins and outs of liquidity risk. What is liquidity risk? Liquidity risk refers to the possibility that an investor or company may not be able to meet short-term financial obligations due to the inability to convert assets into cash without a significant loss in value. In simpler terms, it's the risk of not being able to sell assets quickly enough to pay off debts or cover expenses. Types of liquidity risk. Liquidity risk isn't one size fits all. Different forms of liquidity risk can impact an investor or company in various ways. Let's take a closer look. Market liquidity risk. This type of risk arises when there aren't enough buyers or sellers in the market, making it difficult to buy or sell assets quickly without affecting the asset's price. Imagine trying to sell a rare collectible. If there are only a few interested buyers, you might have to lower your price to make a sale. Funding liquidity risk. This occurs when a company or investor can't meet short-term financial obligations due to a lack of cash flow. Think of it like having a valuable antique but no one willing to buy it when you need money for an emergency. You have the asset, but you can't convert it to cash fast enough to meet your needs. Factors contributing to liquidity risk. Several factors can increase liquidity risk. Understanding these can help you manage and mitigate this risk effectively. Market conditions, economic downturns, sudden market shifts, and political events can all affect liquidity. For instance, during a market crash, many investors may rush to sell assets, leading to a lack of buyers and a drop in asset prices. Economic events. Events such as interest rate changes, inflation, or recessions can impact liquidity. For example, rising interest rates can make borrowing more expensive, reducing the availability of cash for many investors and companies. Asset characteristics. The nature of the asset also plays a role. Real estate, for instance, is usually less liquid than stocks because selling property takes more time and effort. Specialized or niche investments can be even harder to liquidate quickly. Understanding liquidity risk is crucial for making informed investment decisions. It helps investors anticipate potential challenges and plan accordingly. Whether you're dealing with market conditions, economic events, or specific asset characteristics, knowing how to manage liquidity risk can make a significant difference in your financial strategies. The impact of liquidity risk on investment decisions. When investing, understanding liquidity risk is vital. Liquidity risk refers to how quickly an investment can be bought or sold without significantly affecting its price. If an investment is hard to sell when you need cash, you could face losses. Let's dig into how liquidity risk impacts investment decisions. Evaluating investment liquidity. Assessing how easily an investment can be sold is essential. Here are some key methods to evaluate liquidity. Trading volume. The higher the trading volume, the easier it is to buy or sell an asset without affecting its price. Stocks with high trading volumes are more liquid. Check daily or monthly trading volume to see how active the market is for a particular asset. Bid-ask spreads. The bid-ask spread is the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. Narrow spreads indicate higher liquidity, as buyers and sellers are closer to reaching an agreement. Wider spreads suggest lower liquidity. Market depth. This involves looking at the quantity of buy and sell orders at different price levels. Greater market depth suggests higher liquidity. A deep market means it can absorb large transactions without significant price changes. Time to sell. Consider how long it typically takes to sell an asset. Real estate, for instance, can take months to sell, indicating lower liquidity compared to stocks, which can be sold in seconds. By using these methods, you can better understand the liquidity of your investments and make informed decisions. Risk management strategies. Liquidity risk can be managed with the right strategies. Here are some effective approaches. Diversification. Spread your investments across different asset types and markets. This reduces the impact of liquidity issues in any one area. For example, mix stocks, bonds, real estate, and cash in your portfolio. Liquidity management tools. Use tools like money market funds and other cash equivalents. These assets are highly liquid and can provide quick access to cash. Consider short-term debt instruments like treasury bills, which are usually easy to convert into cash. Regular monitoring. Keep an eye on the liquidity of your investments. Markets can change, and an asset that was once liquid can become illiquid. Stay updated with market news and trends that might affect liquidity. Emergency funds. Always maintain an emergency fund in highly liquid assets. This ensures you have access to cash without having to sell illiquid investments at a loss. A good rule of thumb is to keep 3 to 6 months' worth of living expenses in liquid assets. Staggered maturity dates. For fixed income investments, diversify the maturity dates. This way, you have investments maturing at different times, ensuring a steady flow of cash. For example, invest in bonds with different maturity dates such as 1-year, 3-year, and 5-year bonds. Using these strategies, you can mitigate liquidity risk and ensure your investments are not just profitable but also accessible when needed. Case studies. Liquidity risk in practice. Understanding liquidity risk can be easier when we look at real-world examples. Let's explore 2 significant events: the 2008 financial crisis and the recent market volatility sparked by the COVID-19 pandemic. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.